A lot of newbie investors make the mistake of thinking they can find one stock that they can invest in and that'll help them move to a new zip code. Unfortunately, that's not how investing works. We call that looking for the next Microsoft. And lately, at least in the last year or so, investors have been looking for the next Tesla. Now, what are they actually looking for? Are they looking for another electric vehicle company to invest in? No, they're looking for a company that will show them the same sort of returns that Tesla has shown its investors. And today we're going to talk about why we think that's pointless, at least when it comes to looking for the next Tesla. Now, the reason that people look for the next Tesla, the next Microsoft, the next Apple, Amazon is because these companies have made investors a lot of money, not only retail investors, but the individuals that founded these companies. So, 5 of the top 10 wealthiest people on this planet are founders of the companies that you see here on this list. And Tesla's there in 5th place. What made Tesla so successful? Well, a number of things. One being that Elon Musk employed what's called first principles thinking. So he didn't leverage anything that already existed in the auto industry. He literally built everything from the ground up. So he built an auto company from scratch. He didn't need to make the same sort of legacy mistakes as other automakers have made. And in doing so, he took on a lot of risk. And people don't realize that companies that show superior returns also could potentially show a lot of downside. So Tesla could have gone bankrupt and the investors in that company could have lost a lot of money. Fortunately, they made a lot of money. Now, another aspect of Tesla that others will have a difficult time trying to duplicate is the fact that they don't do any advertising. Tesla has some sort of a cult following going on, and their founder does as well. And as a result of not having to advertise, they're able to run very lean. Now, you'll be quick to point out that advertising doesn't contribute to gross margin. You're absolutely correct. So Tesla's gross margin was almost 30% last quarter. Compare that to the typical gross margin in the auto industry of 13 to 21%. And those other automakers spend a lot of money on advertising. That's post gross margin. And Tesla doesn't. So Tesla is the exception to the rule, and expecting that you'll find another company that executes as well as Tesla has, that seems pretty far-fetched. Now, when we look at finding the next Tesla, that's clearly looking at finding another successful electric vehicle company. And we would categorize the EV space into 3 buckets. So the first would be legacy automakers, which a lot of people overlook when they're thinking about pure play EV companies like Rivian or Lucid that are on the cusp of scaling. So that's the third category here, companies that are preparing to scale. And then you have pure play electric vehicle companies that have already scaled. So perhaps there you would include Polestar and Tesla, and perhaps Rivian and Lucid. We'll take a look at that in a second. So if we're looking for the next Tesla, we're looking for an electric vehicle company, these are the places that we'll be looking. Now, we would propose, as we always have, that investors should dismiss any company that doesn't have meaningful revenues. And that's all about scaling. So scaling is selling cars today. It's not about talking about how many cars you're going to sell next year or a couple of years from now. So we may define scaling as a company that sold at least 10,000 vehicles in a single year. And if you haven't accomplished that feat yet, or you're not concretely in the process of accomplishing that feat, then you should be dismissed, because capital is now becoming very difficult to raise, and teams with dreams are going to go bankrupt when investors realize that they're not able to hit the aggressive milestone set in their SPAC deck. So if you haven't already scaled, you'll probably need to go to the market for more capital. That doesn't bode well. So several years back, we wrote a piece titled "A Warning About Electric Vehicle Stocks." And I just took this one example of the hype that was surrounding electric vehicle stocks back then as investors chased the next Tesla. And Roth Capital, which frankly doesn't have the best reputation, had issued this note about Lordstown Motors. And they were raising their price target. Price targets are largely useless, from $12 to $27. And we had highlighted this great point they made here. The potential for a value creation event. Wow, that's speculation if we've ever heard speculation. So we had noted that the analyst was more than doubling their price target based on pure speculation, as opposed to responsibly advising the herd about hype. This stock had risen 524% in less than 2 months. We know about the efficient market hypothesis. It says that if there's no new information made available, then that's probably hype. Indeed, it was. So that great price target of $27 a share, well, that firm now trades at $2.76 a share, and these analysts are probably nowhere to be found. Well, they're probably pumping the next firm that they have been instructed to pump. So Lordstown didn't fare well, and a lot of these SPACs didn't fare well either. So we put together a list of about 14 firms here that went public. The only one that didn't use a SPAC was Rivian. And you can see they raised a lot of cash doing a traditional IPO. Around $16 billion is still on their balance sheet. So I circled 3 companies here that we may want to take a closer look at. Now, we've already written articles about these firms. And if you go to the research piece that accompanies this video, I'll put a link to it in the description of this video. Then you can click on the names of these companies and read our previous research pieces. These were around the time these firms had their SPACs. Now that we know a lot more information, we may go take a closer look, mainly because they're quite popular, not so much that we would be interested in investing in them. So aside from Lucid, Rivian, and Polestar, we have Fisker that only expects 4-digit number of units this year, and Nikola, which you may have seen in the news. Their founder was indicted on 3 counts of fraud, and now their new CEO is bringing hope to the company with plans to produce 300 and 500, or between 300 and 500 units this year. When a company has egg on their face, if the founder was accused of fraud, or the CEO exited in a scandal, or they overpromised significantly and underdelivered in their SPAC deck, we don't give companies like that second chances. We move on. So that would never be a firm we would ever consider looking at again. Now, when it comes to the remaining names on this list, you can read for yourself the updates that we've provided with links to the information. So you have Canoo that's issued a substantial doubt warning, although they're still forecasting production volumes of 3 to 6K vehicles this year. And you can go down the list. None of these companies, and a lot of them now are quite small, and we didn't put the labels here, but the first field is the share price. So since they're SPACs, you can simply subtract that from 10, and that's the percentage that they've fallen. So they're all down significantly. And then the second column there, that's market cap. So you can see that aside from Faraday, Arrival, and Proterra, the rest are under $1 billion market cap. That's in the death zone. We don't invest there. And then that third column, that's the cash that they have on hand. So the firm with the most cash here would be Arrival with around 800 million. Then you have Proterra, and then it goes downhill from there. So when these companies look to raise more money, investors are going to say, well, how did you fare when it came to the last promises you made your investors? And that's when things are going to turn ugly. So the only company here I think we might take a closer look at is Proterra. So they're pivoting from electric buses into electric vehicle infrastructure, and they actually have pretty meaningful revenues. Now that we have some decent filings to look at, we may do an updated piece on them. So aside from that, none of these other companies we're going to take another look at. We might. So Arrival generates a lot of interest, and we did a video on that you can check out. Arrival has made some great promises. It sounds so good, but can they execute? That's the most important question. So when looking at all these firms that went public in the last several years, investors kind of ignored what the legacy automakers have been doing. So I always love this diagram that shows how 14 car companies control a combined 54 brands. And there's some names here absent. That would be some Chinese names probably belong on this list as well. But this is still interesting that all these companies here are dabbling in electric vehicles. Names like Volkswagen, Hyundai has made some big investments in electric vehicles. I think by 2030, they plan to have 3 million vehicles a year produced. And when we start talking about numbers like how many electric vehicles any particular firm is going to be producing, we probably want to put that in context. So we thought it would be interesting to take a look at how many electric vehicles are being sold. So as a percentage in 2021, 10% of light vehicles sold, so pretty much cars and pickup trucks, 10% of light vehicles sold were electric. So we wanted to check those numbers. So we pulled this table here. This shows the number of light vehicles produced around the world in the first quarter of 2022. So about 14 million light vehicles were sold globally in that quarter. All right. So if you remember that number, so that's 14 million. Then we pulled this information from an entirely different source that it's the 10%, so it'll be about 1.4 million electric vehicles units were sold in that same quarter, and 55% of those belonged to these 5 companies. Tesla at the top, of course, with a 21.6% share. That's down from 25% the year prior. And these other 2 names here, SAIC and BYD, we'll talk about in a second. Then you have Volkswagen, also with some market share dropping, and then Hyundai with a 5.7% share, which didn't have a meaningful share last year. So these are companies to be watching. Now, when it comes to the number 2 and number 3 names here, SAIC is the largest automaker in China. So they're certainly a formidable contender. And then you have BYD. They're a Chinese firm that Buffett actually invested in. They're the largest electric vehicle manufacturer in the world. Now, there are some opportunities for electric vehicle companies in China, names like NIO or BYD or NIU. And what you need to remember about Chinese firms is that most of them, nearly all of them that list here in the United States, they list using VI structures. And several years back, we exited our Alibaba position, which was our largest position at that time. Turned out to be a good time to exit because we were digging into these VI structures and became extremely uncomfortable with what we found, and we will not invest in VI structures. And at that time, we couldn't find too many people sounding the warning bell, but down here at the bottom, you can see this was the chair of the SEC last year, about a year ago, saying, I worry that average investors may not realize that they hold stock in a shell company rather than a China-based operating company. What he's referring to is that these VI structures provide exposure, quote unquote, to China-based operating companies through a series of service contracts and other contracts, all through shell companies in the Cayman Islands. It's a big mess. And China has recently began addressing that because they recognize that foreign investment, and the whole reason these VI structures exist is because of Chinese law that prevents foreign investors from investing in Chinese firms. So the point here is that we don't invest in Chinese companies that utilize VI structures. So the second question would be, well, what about firms that list in Hong Kong? Well, that's a very good question. BYD trades in Hong Kong. That's something that we need to look into. So there's a fair amount of due diligence that needs to go into that, as well as looking into the companies themselves. So a lot of malarkey happens in China that would ruffle some feathers over here. There have been examples of firms going bust over there that would make Enron look saintly. So China is a very difficult environment to navigate, whether you're doing business there or whether you're investing there. So that is on our to-do. We simply wanted to note that there is opportunity in the largest automotive market in the world. As we saw in our previous slide here, you can see China is by far, it's almost as large as what Europe and USA combined, and they were the only country or region that saw growth in the first quarter of this year compared to the previous year. So China certainly has some opportunity, but the question say a bigger question we need to ask is, do we want to be investing in auto companies to begin with? And it doesn't matter how many electric vehicles get sold by Volkswagen or Hyundai, it's still a legacy automaker that's selling them. So we'd argue that the process of developing a vehicle, manufacturing it, marketing, selling, servicing, that doesn't change much when you move from gas to electric. So take a look at BYD, so the world's biggest electric vehicle manufacturer. They have gross margins in the 13% range. Compare that to Tesla in the 30% range. So Tesla is certainly the exception, but do we really want to be investing in automakers? We'd argue that no, we don't want to invest in automakers. Otherwise, we would do that. What we might want to invest in is a much bigger opportunity that some investors overlook when they consider the Tesla thesis, and that is autonomy. So, question we've raised here, autonomy or electrification? Well, it can certainly be both. In the case of Tesla, it is. These pie charts are taken from ARK Invest. This is around their latest bull thesis on Tesla, which assumes that by 2026, more than half of Tesla's profits will come from a robo-taxi offering. And you can see here they've broken down on the left revenue by electric vehicle versus robo-taxi versus human-driven ride hail and insurance. And on the right, you can see profits. Now, they're assuming that Tesla, when they develop their robo-taxi, will be able to offer rides to individuals at a price that's 1/10 of what Uber and Lyft can offer. All right, at a 50% margin. That's crazy. So you could see that if that even partially comes true, it's very bullish for Tesla. So autonomy seems to be where at least half of Tesla's potential will come from, and that has yet to be realized. So, what about the autonomy thesis? Well, we've investigated that quite in depth over the past years, and it largely surrounds private companies at the moment. So, two firms that seem to be in the lead right now would be Cruise and Waymo. So, Cruise is backed by GM, or subsidiary of GM actually, and Waymo is with Google. And both of these companies are allowed to take paying passengers in San Francisco right now, though Waymo has to have an operator present. And they've been testing autonomous vehicles for a while now. Cruise uses all-electric Chevy Bolts, and Waymo uses Chrysler Pacifica Hybrid minivans, among other vehicles. So you don't need to have developed an electric vehicle to successfully run with the autonomy thesis. So we look at Tesla's robotaxi, which has been overpromised and underdelivered, there may be a reason for that. Tesla may be delaying that offering so they can see what mistakes their competitors are making. So recently you would have read about Cruise's 20 of their vehicles getting together, swarming together and blocking a street in San Francisco. So strange behavior like that. Tesla has a much bigger profile, so they can't really afford the publicity. And Elon Musk, for whatever reason, now has seemed to amass a large number of haters when he has probably done more to help the planet than any of the placard waving individuals condemning him. But be that as it may, Tesla's robotaxi is not here yet, but it may be coming soon. And when it does, it may dominate just because, again, Tesla doesn't need to do much advertising. They're just a beast when it comes to how they approach problems, how they solve them, and how they execute. So when we consider electric vehicle firms, we're not interested in automakers or companies that produce hardware. We're more interested in firms like Gogoro. So this was a company we profiled recently. They've developed a scooter that is ubiquitous in Taiwan, and it uses a lot of technology, most notably this swappable battery that weighs about 20 pounds. Try to swap a battery in a car, it's about 1,000 pounds, where battery in a scooter is a different story. And they have these battery swap stations, and 100% of individuals that buy a scooter enabled by Gogoro technology purchase a subscription. There's a recurring revenue element. It's a very interesting business, but they're only in Taiwan at the moment. Now they're expanding into China. That's tough to do. We want to see how that goes before we would consider investing in this company. So Gogoro is a great example of a company that doesn't just develop and sell electric vehicles. They built an entire ecosystem around them using the latest and greatest technology, and it's a very interesting business. That is similar to how Tesla addressed the electric automobile. So when we talk about finding the next Tesla, it's really about finding innovation and a lot of potential. So just to conclude, the three companies we talked about today, we may take a closer look at: Lucid, Polestar, and Rivian. Stay tuned for articles or videos on those firms. And plus, we'll do a follow-up on Proterra, since they have quite a bit of meaningful revenue and they now have enough information that we can sift through and see what the potential that firm looks like. Now, when it comes to these other companies, these up and comers like Lucid or Rivian, we always want to invest in leaders. So that poses a problem. And when we look at any tech theme, we always want to be investing in the leader because they have the dominant advantage. And of course, Tesla has a big advantage over everybody for the reasons we've discussed today. So legacy automakers, they're out from an investment perspective. And the question here is the real opportunity in autonomy, at least when it comes to light vehicles. So please put your comments in the comments section. Make sure to subscribe to our channel. Thanks so much for taking the time to watch this video today.